A friend named Andrew called me on a Sunday morning a few months back, sounding stressed enough that I asked him if everything was okay before he could even tell me why he was calling. He was 45 years old, and he'd just crossed $500,000 in his retirement accounts. You'd think hitting $500,000 would feel like a victory. For Andrew, it didn't. He was looking at the gap between $500,000 and the $2 million he figured he'd need by 65, and he'd just done the mental math that he had less than 20 years to make up the missing $1.5 million. Andrew was convinced he was way behind. He asked me what he needed to change. I told him to send me his account balance, his current contribution rate, and his target retirement age, and I'd run the numbers and call him back. 15 minutes later, I called him back, and the conversation we had on that phone call is what this video is about. What I told Andrew is that he had a fundamental misread of his own situation. The $500,000 he had didn't need to compound into $2 million over the next 20 years. The $500,000 was already going to do almost all of the work on its own. At a 7% real return, his existing balance without any additional contributions would be worth roughly $1.93 million by the time he was 65. The contributions he was already making on top of that pushed the total to around $2.34 million. He wasn't behind, he was almost there. The reason he couldn't see it was that he was staring at the gap instead of looking at what compound was about to do for him over the next 2 decades. That's the rule that almost nobody who crosses 500,000 internalizes. The hard part of the journey is structurally over. What remains is mostly waiting, with a short list of things you have to not screw up. The 8 rules in this video are that list. I'm Tom. This channel is about real personal finance, the kind that actually works for normal people, instead of the kind that gets you to click on a thumbnail. No motivational fluff, no fantasy returns, no get rich quick. Just what the math actually does over time. If that's what you want, hit subscribe. The reason 500,000 specifically matters is that it's the threshold where the relationship between you and your money fundamentally flips. Below 500,000, your contributions are the dominant force in your wealth growth. Above 500,000, compound is the dominant force. That sounds like a small distinction. It isn't. The behaviors that got you to 500,000 are not the behaviors that get you from 500,000 to 2 million. Different skills, different mistakes, different rules. And almost nobody is told this. Let me walk you through the 8 rules. Rule 1. The 2 million is already in the mail. The first rule, and the most important one, is the math I ran for Andrew. If you have $500,000 invested in broad market index funds at a 7% real return, the portfolio compounds to approximately $1.93 million over 20 years with no additional contributions. Not a single dollar more added. That's the result of compound alone, working on the balance you already have. That number deserves to sit with you for a second. $1.93 million without saving another cent, without changing anything you're doing. Now layer modest contributions on top. Most people at 500,000 are saving somewhere between $10,000 and $20,000 a year, depending on their income. At $10,000 a year, the 20-year compound becomes about $2.34 million. At $20,000 a year, it's roughly $2.75 million. Your contributions still help, they just no longer have the leverage they used to. The original 500,000 is doing 80 to 90% of the work from here forward. Your savings rate, which was the entire engine for the first 20 years of your financial life, has been quietly replaced by compound as the primary driver. For comparison, the same math from 200,000 looks very different. 200,000 at 7% real with no contributions reaches 2 million in roughly 34 years, not 20. The reason 500,000 is the threshold the rest of this video is built around is that 500,000 is the first balance from which the journey to 2 million fits inside a normal working career by compound alone. This is the rule that flips the psychology of saving. For the entire journey from 0 to 500,000, the saving felt productive because it was producing most of the growth. After 500,000, saving still feels productive, but produces a fraction of the growth. People who don't notice this mental shift end up exhausting themselves trying to save harder when the lever has moved. The lever is now not interrupting compound, not maximizing the contribution. Rule 2. You've crossed coast fire. If you've never heard the term, coast fire is the moment when you have enough invested that, without any further contributions, your portfolio compounds to your retirement number. The phrase comes out of the financial independence community, and it's the most useful single concept I've encountered for thinking about middle-aged finances. The idea is that the heaviest financial work doesn't have to happen for 40 years. It has to happen for about 15, and then compound does the rest. For most middle-class American households with reasonable retirement targets, coast fire happens somewhere between 400 and 700,000 of invested assets, depending on age and retirement spending. 500,000 at 45 is squarely in coast fire territory. You don't have to keep saving aggressively to retire comfortably. You could throttle contributions back to 0, take jobs you actually enjoy that pay less than your peak years, take a sabbatical, switch careers, and still arrive at a perfectly reasonable retirement number on schedule. The math is doing the work whether you're contributing or not. I'm not saying stop saving. I'm saying recognize what the math is telling you. The reason this matters is that most people in their late 40s or 50s who hit 500,000 still feel like they're in the early career grind phase, where every dollar saved is critical to the outcome. They're not. The early career grind phase is structurally over. You're now in the let the compound run phase, which has a completely different psychology and a completely different optimal set of behaviors. Knowing you've crossed coast fire is what unlocks the kinds of choices that didn't seem possible before. It's what makes a career switch in your 50s actually viable, and it changes how you treat the financial cushion you've built, from something you keep adding to forever to something you can actually use when the situation calls for it. Rule 3. Your portfolio now out-earns the median US household. At $500,000 invested at a 7% real return, your portfolio generates roughly $35,000 a year of growth, just from sitting there, without you doing anything. Now put that in context. Per the Bureau of Economic Analysis, the US personal savings rate has been running around 4% in recent quarters. On the most recent median household income of about $84,000 a year, that's roughly $3,000 to $4,000 of new household savings annually. So your portfolio's annual growth is somewhere between 8 and 10 times what the median American family contributes from their entire year of labor. Said another way, your money does in 12 months what most American households can't do in 8 to 10 years. The implication is the part most people miss. The relative weight of your contributions versus your portfolio's performance has decisively flipped. Your savings rate, which used to be the most important number in your financial life, is now the second most important number. The first is whether your portfolio is allocated in a way that captures broad market returns without paying excessive fees. A 1% expense ratio on $500,000 costs $5,000 a year, which is more than the entire annual savings of the median American household. The fee structure on your accounts is now doing more financial damage than most people's lifestyle decisions ever could. This also explains structurally why financial salespeople become much more interested in you at $500,000 than they were at $200. You've crossed into the dollar range where their cut of your account justifies their time. Rule 5 gets into that in detail. The point here is that your portfolio has crossed a productivity line, and your job is no longer to keep adding fuel. Your job is to not leak the fuel that's already burning. Rule 4. Sequence of returns becomes your new risk. The risk model at 200,000 is volatility, the ups and downs of the market. The risk model at 500,000 starts shifting towards sequence of returns, which is a different and more dangerous concept that almost nobody understands until it's too late. Sequence of returns risk is the math problem that says the order of your returns matters, not just the average. A 30-year period averaging 7% real can come from consistent 7% years or wild swings that happen to average 7%. For someone in pure accumulation, both outcomes lead to roughly the same place. For someone close to retirement, the two outcomes are dramatically different. Here's the math that makes it concrete. Two retirees, both with $500,000 at retirement, both withdrawing 4% a year, both eventually averaging 7% real over a 30-year retirement. Retiree A gets a great first 5 years with double-digit returns, then a brutal stretch in the middle. Retiree B gets a brutal first 5 years with consecutive losses, then great years in the middle and end. The averages over 30 years are identical. The outcomes are not. Retiree A finishes with substantially more wealth than they started with. Retiree B finishes with a fraction of that, and in the worst historical sequences, runs out of money before their retirement does. Research on retirement plan failures consistently finds that negative returns in the first 5 years account for roughly 70% of cases where the portfolio runs out. The reason is that drawdowns interact with withdrawals. When you draw on a portfolio during a bad stretch, you're selling shares at low prices, and those shares can't recover when the market does. When you draw on it during a good stretch, the math works in your favor. This is the risk that suddenly matters at 500,000 and didn't matter at 200. At 200,000, you were nowhere near drawdown, so sequence didn't apply. At 500,000, you're close enough to retirement that the first 5 years of withdrawals will determine most of the trajectory. 2 fixes are worth knowing about. Build a cash buffer of 2 to 3 years of expenses by the time you retire, so a bad early year doesn't force you to sell at the bottom. And consider a glide path that reduces equity exposure modestly in the 5 years before retirement, which trades some upside for sequence protection. Both are technical adjustments, and they're worth making, because the cost of getting sequence wrong at this stage is measured in decades of lifestyle. Rule 5. Wealth managers start hunting you, and a 1% fee becomes a 6-figure tax. You'll notice sometime in the year after you cross 500,000 that the financial services industry has gotten more interested in you. The mail volume picks up, with invitations to complimentary financial planning consultations, calls from wealth advisors affiliated with banks you may or may not use, dinner seminars on retirement strategies, and LinkedIn messages from people who somehow figured out where you bank. This isn't your imagination. 500,000 is the threshold where most retail wealth management firms find your account size profitable enough to actively pursue. Their primary product is an assets under management arrangement, where they charge you somewhere between 0.8 and 1.5% of your portfolio per year in exchange for managing it. That sounds reasonable on the surface. The math is anything but. 1% of 500,000 is $5,000 a year. As the portfolio grows over 20 years, the total fees you'd pay add up to roughly $195,000 in cumulative payments. But the real cost is what those payments would have been worth if they'd stayed invested instead. Compound the foregone fees at 7% over the same period, and the all-in damage is closer to $350,000 of retirement assets you no longer have. So a 1% annual fee over 20 years removes roughly $350,000 from your retirement balance. That's the math the wealth management firm doesn't walk you through. The defense isn't to avoid all professional advice. It's to know what advice is worth paying for and what isn't. A flat fee-only financial planner who charges $3,000 to $5,000 for a comprehensive plan every few years is providing genuine value. A 1% of assets wealth manager who rebalances your portfolio twice a year and sends you a quarterly statement is, in most cases, taking a six-figure cut of your retirement for work you could do yourself in a few hours a year. The sales pitches at this level are sophisticated. The math is what tells you when you're being taken. Rule 6. Asset location now matters more than which account you use. There's a difference between asset allocation, which is what mix of stocks and bonds you hold, and asset location, which is which specific assets sit inside which types of accounts. Below $500,000, allocation is what matters, and location barely moves the needle. At $500,000 and above, location starts being worth tens of thousands of dollars in additional after-tax wealth over a decade, and almost no retail investor gets it right. The general principle is that tax-inefficient assets, like bond funds and real estate investment trusts, belong inside tax-deferred accounts, like a traditional 401k or IRA, where their high tax drag doesn't matter because nothing is taxed inside the account anyway. Tax-efficient assets, like broad market stock index funds, belong inside taxable accounts, where their low turnover and qualified dividend treatment keep the annual tax bill manageable. International stock funds belong in taxable accounts if you want the foreign tax credit, which lets you offset foreign taxes against your US tax bill. Individual stocks, if you hold any, belong in taxable accounts, so you can take advantage of long-term capital gains rates and the step up in basis at death. For someone with $500,000 split between taxable and tax-advantaged accounts, getting location right versus wrong is worth tens of thousands of dollars in additional after-tax wealth over 20 years, depending on tax bracket and account mix. Per Vanguard's research, asset location can add up to 30 basis points of after-tax return annually, which compounds into real money over a working lifetime. That kind of optimization mattered very little at $200,000, when the absolute dollars were small. At $500,000, it starts being one of the highest return uses of your attention. Most retail investors get this wrong because they default to putting the same allocation in every account. A 60-40 mix in the 401k, a 60-40 mix in the IRA, a 60-40 mix in the brokerage. That's clean and intuitive. It also costs real money in taxes that wouldn't have to be paid if the assets were sorted correctly across accounts. The fix is a one-afternoon project. The savings compound for the rest of your life. Rule 7. One mistake now costs more than 1 year of contributions earns. The math here is uncomfortable but useful. At $500,000, the cost of a single major behavioral mistake has grown to where it exceeds the benefit of a full year of contributions. Consider a 50-year-old with $500,000 who panics during a market drop and sells out at the bottom, then misses the recovery before getting back in. Based on historical recovery patterns, the realistic cost of one panic sell episode is somewhere between $50,000 and $100,000 of foregone wealth over the rest of their working life. The same person, contributing $20,000 a year for 15 years at 7% real, adds about $500,000 to their retirement. Here's the asymmetry. A single $50,000 panic sell mistake, projected forward 15 years at 7%, costs about $140,000 in foregone wealth. So one bad weekend driven by behavioral patterns the brain is wired for, erases roughly 3 years of disciplined contributions. The mistake costs more than the discipline earns over a meaningful time horizon. This is why the most important skill at 500,000 isn't saving more or earning more. It's not screwing up. The behaviors that wreck $500,000 portfolios are well documented. Panic selling during drops, chasing performance after rallies, concentrating in individual stocks or themes that recently went up, borrowing against the portfolio for speculative bets, and switching to active management chasing recent winners. Every one of those has a price tag that at this account size exceeds what another year of saving can offset. The implication is that the optimal allocation of your attention has shifted. You used to need to focus on saving more. Now you need to focus on not breaking what you've built. The portfolio is fragile in a way it wasn't before, not because of market risk, but because the dollar cost of your behavioral mistakes has scaled with the balance. Rule 8. Your time horizon flips from accumulation to preservation. The final rule ties the other 7 together. Below 500,000, you were in pure accumulation mode. Everything was about adding more, saving more, earning more. The goal of every decision was to make the portfolio bigger, faster. The risks you took were upside risks, and the mistakes were errors of omission, the things you didn't do. Above 500,000, the dominant mental model has to flip from accumulation to preservation. You're not abandoning growth. The portfolio still has to grow to get to 2 million and beyond. What changes is the frame. The question is no longer, how do I make this bigger? But, how do I let this grow without breaking it? The portfolio is now an asset you're protecting, not a target you're chasing. The behavioral implications are significant. Daily balance checking becomes counterproductive because daily fluctuations are now in the 5-figure range, and watching them just teaches your brain to react. Most market commentary becomes noise to filter out, because most of it is designed to provoke action, and action is now the enemy. Reflexive allocation changes in response to recent events become the killer, because allocation drift is what wrecks portfolios at this stage. You start treating the portfolio with the same care you'd treat a precious thing that took 20 years to build, because that's exactly what it is. This mental shift is the hardest one to make, because it goes against the instincts that got you here. The same person who built the 500,000 through aggressive saving and disciplined investing has to switch modes once they have it. The instincts that worked in accumulation, the constant looking for ways to optimize and improve, become liabilities in preservation. Holding still becomes more valuable than the skill of moving. Most people never make this switch fully. The ones who do are the ones who arrive at 2 million on schedule, intact, with the money they were supposed to have. The ones who don't keep tinkering, keep optimizing, keep making one more move, and end up with portfolios smaller than they would have been if they'd simply left them alone. So those are the 8 rules. The 2 million is already in the mail. You've crossed coast fire. Your portfolio out-earns the median US household. Sequence of returns is your new risk. Wealth managers are hunting you, and 1% fees are a 6-figure tax. Asset location matters more than which account you use. One mistake now costs more than 1 year of contributions earns. And your mental model has to flip from accumulation to preservation. Here's the part I'd want viewers to take with them. If you're sitting somewhere south of 500,000 and watching this thinking it isn't for you yet, the reason 500,000 matters isn't the round number. It's that 500,000 is approximately the balance from which the journey to 2 million fits inside a normal working career by compound alone. The threshold isn't arbitrary, and you don't get there by being extraordinary. You get there by saving consistently into low-cost index funds for somewhere between 15 and 25 years, depending on your income and your discipline. The threshold is reachable for almost everyone watching this video. The question is whether you give the math enough time to do its part. For viewers above 500,000 who recognize some of these rules running in your life already, the question worth sitting with is whether you've actually flipped from accumulation mode to preservation mode in your head, or whether you're still operating on the instincts that got you here. The honest answer for most people is that they haven't flipped yet, even though the math has. That flip is the difference between arriving at 2 million on schedule and getting most of the way there, but giving back a chunk through avoidable mistakes. Andrew, the friend I started this video with, did end up calming down by the end of our phone call. He'd gone from thinking he had to find a way to make up a missing 1.5 million in 20 years to realizing he had to figure out how to not screw up the next 20 years while Compound did the work. That's a smaller and more manageable problem, and it's the actual problem at 500,000. The work changed underneath him. He just hadn't noticed until somebody walked him through it. Drop a comment with which of the 8 rules hit hardest, or with which one you're doing the worst on right now. I read every comment, and if you want me to walk through the structural shift that happens at $1 million, which is a different conversation again with different risks, hit subscribe. That's the next video. I'll see you in the next one.